Good morning, hello and welcome to Opening Bell. You're with us on Moneycontrol. I'm Surabhi Upadhyay. It's a Thursday morning and we've woken up to better cues. There is a bit of a relief rally across asset classes, across world markets, and the hope is that we'll finally get some semblance of de-escalation in the Middle East. Lots to cover. Will the bulls have a real fighting chance to come back here in India? That's the big question as we kickstart trade this Thursday morning. Let's get you the headlines first up. The death toll in Iran crosses 1,000 as Israel and US continue to pound the country. The US Senate Republicans back Trump's military campaign against Iran, voting to block a resolution aimed to stop the war and require any authorization by the Congress. The US Defense Secretary confirms a US submarine sank an Iranian warship off the southern coast of Sri Lanka, killing dozens. Stocks on Wall Street rebound after a report that Iran had signaled openness to talks. The Dow adds more than 230 points, while the S&P 500 gained 50 points and the Nasdaq added almost 300 points at close. Markets in the Asia-Pacific region track gains from Wall Street. They open higher. South Korea's Kospi rebounds 12%. The GIFT Nifty is indicating a positive open for Indian markets. Brent oil climbs more than 1% in Asian trading, extending this week's advance after a US submarine reportedly sank an Iranian warship off the coast of Sri Lanka. Meanwhile, gold builds on to gains as investors sought safety amidst tensions in West Asia. And on the tariff front, a U.S. federal court has ordered President Donald Trump's administration to begin processing refunds on tens of billions of dollars in emergency tariffs. This comes even as Treasury Secretary Scott Bessent says that global tariffs will be raised from 10% to 15% soon. Okay, all right. So what's behind all this green that we're seeing on global screens? It is a report from the New York Times that indicated that Iranian intelligence officials or operatives, they actually had reached out to the CIA immediately after the first round of attacks. And the report is indicating that there perhaps were some overtures of starting dialogue, starting a conversation. Now, we don't know how well this plays out because the strikes have continued, including that sinking of the vessel off Sri Lankan waters, and this vessel was returning from an Indian Navy exercise. So, therefore, you have these twin factors, but markets want to believe that there is going to be de-escalation, and that's how all asset classes shaped up. So, if we talk about equities, US equities were up about 0.5% to almost 1.2, 1.3%, depending on what you saw yesterday. Oil prices, however, edged higher, and Brent oil is still very much around that 83 handle. So we have come back to not oil at 80. We've come back this morning to oil at 83. So the concern in the oil market is still very much visible. Now, Scott Bessent went on to say that the crude oil markets are very well supplied. He also went on to say that the US will be reaching out soon to individual ship owners and insurance brokers because they're the ones who need to be convinced if the Strait of Hormuz is to really restart in any meaningful way. So that's what the US is claiming at this point in time. Not much of a move. The dollar index is still around it's just below the 99 handle. Yields have been range bound. Markets are still very, very cautious with respect to what happens, what this means for inflation because oil is still higher. Pete Hegseth, the US Secretary of War, went on to say that the US has enough stockpiles. And there was all this speculation whether the US can keep its counter operations really on. And they said that we have enough ammunition to keep this fight on for as long as it needs. It'll be on till the time it needs to take to ensure success. So that was the statement coming in on the war front. Asian markets are extending the rally that we saw on Wall Street, and actually it's a huge rally. Look at what happened on the Kospi. Kospi up almost 11%, undoing a lot of yesterday's big declines. The Japanese markets have been surging. The Nikkei was up over 3.5% in morning trades. Now it's come down to just a gain of less than 3%, just below 3%. Chinese markets are also up. Hang Seng is up. Mainland China is up. And this despite the fact that China has set its lowest growth target on record for 2026. They're only expecting 4.5 to 5% growth, GDP growth that is. That'll be lower than the 5% target they had set last year. The question for all of us, looking at the entire global backdrop, is that there is a relief rally underway. India is likely to participate. The GIFT Nifty is indicating we'll probably start about 100 points higher. And we saw some of that yesterday. The market did see buying in select stocks at lower levels. So there is obviously nervousness. The VIX is very, very elevated at about 21. It surged again at about 20% yesterday. The rupee continues to track the surge on the dollar. The rupee fell to fresh lows yesterday. It breached the 92 mark. There's constant FPI outflows. FPIs yesterday sold off cash stocks worth almost 8,700 crores. Domestic institutions were big buyers yesterday, almost 12,000 crores of buying from the DIIs. But the question is that with all this negativity, are we set for a bounce? There are people who will say that the market is way oversold. So a short bounce is very much likely. The question is what happens after we get this small little gap up in the morning. And that's what we will discuss with our guests on the show. Chandan Taparia joining in from Motilal Oswal. He, of course, looks at the F&O space and the technicals very, very carefully. And then we have Pankaj Pandey joining in from ICICI Direct. Good morning, Pankaj and Chandan. Great to have both of you on. So actually, let me ask the trading question first. Chandan, opening with you. Because of the cues that I just mentioned, we will probably get this 50, 60, 100-point gap up opening. What should traders be doing with this gap up?
Good morning, Surabhi. Thanks for having me. So the immediate structure has turned negative as market broken its 200-day exponential moving averages, even gone below budget day low. It has been making lower top, lower bottom. So rather than recovery, market required some follow-up activity. We have seen a corrective move from 26,000 to below 24,500 marks. If it moves beyond 24,750, then only the time being stability will be back. We have noticed that on last trading session, the market declined, witnessed some recovery, but again, the follow-up was missing in the market. So today, if opens positive, that's good, but needs to hold beyond 24,600 to 24,750 marks. So there is the wall of worry, and I believe market needs to surpass with decisive momentum. Then only the positive stance will be there. But the good part here is that selective sector and stocks will do in this scenario. So like we have seen buying interest in few PSU banks, few capital goods counter are witnessing buying interest, new age business are getting some recovery, defense counter are finding some buying interest. So we need to look at the broader range between 24,200 to 24,750 if Nifty is concerned.
So Chandan, will you rush to short the bounce or will you just let the index settle? I mean, because, yeah, go on.
Yeah, so I won't rush now because the India VIX has spiked by around 50% in last 2 years. The VIX, which was near 13 levels, now it's near 20 plus marks. So higher VIX clearly indicates that swings will be there in the market. If I just simply calculate the VIX and the standard deviation band, the 300 to 400 points movement is going to be the new normal in this scenario. So till VIX doesn't go below 15, 16, it would be tough for the market to get or trade the recovery mode because there might be the recovery of 200 points, again decline in the recovery. So it would be tough in that scenario. So I'll closely watch VIX to settle lower to initiate the trading bit. Otherwise, I'll only focus on strategy or will focus on the selective sector or stocks in this market scenario.
Got that. Okay, Chandan, thank you for the opening thoughts there. Coming back to you for more questions. Pankaj, good morning to you as well. Thank you so much for joining in. What's your sense, this relief rally that we're seeing across global markets? When markets get oversold, these bounces are very normal. Would you treat this as a sign that we are past the worst? Or is there still good reason to be very cautious and not get carried away with the bounce?
So hi, good morning, Surabhi. I think overall sense is that, it's difficult to call bottom because this broader market or overall market recovery will be a function of the duration of the conflict. And I think that is where the challenge lies. But our sense is that with air superiority sort of coming in with US and Israel, probably this conflict is not going to last very long. But if I have to sort of go by the cues in terms of Russia-Ukraine war, at that point of time, the crude had touched about $112 per barrel. And we had seen a decent correction in the market. But what happens after 3 months or 6 months down the line is that the markets largely recoups most of these losses In fact, market has done better. So I think during that point of time, 3 months after that, market making bottom, the rally was about 19 odd percent and about 25% in the 6 months. So what needs to be watched is again the duration of the conflict. But our sense is that in this kind of a correction, we will get an opportunity to sort of buy because most of the fundamentals are in place for markets to sort of do well. We have already concluded the earnings season where across large caps, mid caps, and small caps, the earnings have been a lot better. The much awaited India-US trade deal is largely done. So from that perspective, I think most of the ingredients are there in the market to sort of do well. I think barring the short-term volatility, and again, like I said, it's very difficult to sort of put a time frame. But our sense is that it is not going to last longer, given the fact that overall scenario looks a lot better or it's going to be a sort of a more of a one-sided war from here on. So that way, I think this correction is an opportunity to buy, and which is why I think one should be taking or looking at stocks where the corrections are significant. And we have already seen significant correction happening in some of the counters.
Okay. So that's what we have to talk about as we go forward. And I want to start with the oil and gas space, Pankaj, because that's where we've seen pretty intense moves yesterday and huge moves at that, right? Stocks like Petronet collapsing 8-9%, and the gas stocks were all over the place. Mahanagar Gas was down 6-7% because that's the real worry now. What did you make of these big outsized moves on gas stocks, city gas distribution, something like a Petronet LNG, GAIL, and what would your advice be on this entire set of companies?
So I think oil and gas is a very sensitive sector, and obviously I will not really want to sort of chase or recommend this segment because, see, when you look at about 50% of our crude oil imports or 55% of the LNG imports come through there, and even 80 to 85% of the LPG imports happen through that particular route. So obviously there the level of comfort is a lot more lesser, but a lot of other segments which have been sort of impacted, I would want to believe that they would offer buying opportunities. The case in point being, say, for example, when we look at paint companies, when the Russia-Ukraine war happened, we have seen that there was a margin pressure of about 400 odd bips in the subsequent quarters. So I think if Asian Paint is sort of correcting, I would want to sort of look at that. Similarly, when we sort of look at some of the companies, say, for example, in the hospitality space, our sense is that we might see 2 to 3% kind of a lower growth or impact in the RevPAR for some of the hotel companies because obviously the tourist flows will get sort of impacted. But our sense is that the overall revenue pie is still a lot more lesser. So we would sort of look at an opportunity there. Similarly, for cement companies, pet coke imports are sort of a significant from there. But you do have alternatives in terms of imported coal or even pet coke being sourced from somewhere else. So similarly for autos also, the freight cost is expected to sort of go up. So our sense is that some of these segments is what we would sort of look at from a buying opportunity perspective. Oil and gas will continue to remain challenging till the time the crude does not sort of come down or the Hormuz transit route is fully secure.
Sure enough. Chandan, levels on some of these stocks. I'm talking about yesterday's big movers, IGL, MGL, Petronet LNG. If you could just give us, have they broken a lot of important levels yesterday? If someone is still holding on to positions, hoping for a bounce, what should they be doing? Or is it best to cut your losses and move out? Yeah, Chandan? Oh, I think we've just lost that line with Chandan. We'll get him back in a bit for that. On the other end of the spectrum, on oil and gas on the upstream side, Pankaj, that is where people are kind of, drawing a straight corollary, expecting that ONGC is going to be a beneficiary, Oil India will be a beneficiary. So you can be in these stocks at least for the near term. Do you subscribe to that view?
I don't, because Surabhi, see, largely when you have to sort of look at some of these upstream companies, one, I think the volume growth is pretty muted because oil and gas volumes really do not go up in the near term. And I think, again, if someone is taking a call on the pricing of crude oil being at elevated levels for a longer period of time, I wouldn't sort of subscribe to that because we have already seen that the rewiring of the supply chain happens quite quickly. And crude oil demand is not something which is very robust, so it is largely a supply-driven market. And India, even other countries do have options in terms of Russian crude oil sort of pitching in. So I wouldn't want to sort of bet or recommend just on one lever in terms of crude oil prices being at elevated levels. So yes, one can take a trading call, but nothing from the portfolio perspective, I would suggest.
Okay, got that. I think we've got Chandan back with us. So Chandan, just rounding this up with you, my question was just that for anyone who's seen big losses and has been holding these stocks, the gas stocks, what is the advice?
So, like I was talking about IGL, it has been making lower top, lower bottom from last 6 months. Major support is 153, which respected well in the November 2024. But I think if that level is broken, 5 to 10% more corrective move cannot be ruled out. So 153 is immediate support. If you are a trader, use that level. Even below that, one can initiate the short position. While on the upside, till it doesn't surpass above 165, 168, it would be tough to hold any kind of recovery in the counter. Looking at MGL, Mahanagar Gas Limited, it witnessed recovery in last 2 weeks, but again, momentum fizzled out. Multiple supports are visible near 1030, but hurdles are intact at 1150 marks. Petronet comparatively may be resilience or maybe range bound. Multiple supports are near 263. So if we have to compare all three, I believe Petronet can be buy on decline, while MGL and IGL are weak and structure may remain weak even from current level as well.
Okay, all right. So that's the entire oil and gas space, which was in sharp focus yesterday. We'll come back and we'll discuss more of these Middle East hit stocks, if I could call them that, L&T being one of them. I'll come back with that view. But there are a couple of additional names beyond all the Middle East exposure stocks that we should keep on our radar. So quickly running through today's stocks and news. Polycab is going to be in focus. The company has received a tax demand order of about 327 crore rupees. Now, this is coming from the Office of the Deputy Commissioner of Income Tax, Mumbai. So let's see if sentimentally there's a bit of a downtick on Polycab today. BSE is, there's good news surrounding BSE. BSE is getting active and it is going to be offering more products for traders to look at. It has received SEBI's approval to launch derivative contracts on the BSE Sensex Next 30 index. So right now you have these weekly contracts on the BSE Sensex and the BSE BankX. Now there'll be more indices on which they'll have these contracts. So it'll allow more trading and perhaps more volume. So watch for BSE, could be positive. Speaking of the gas counters, we were just discussing them with our guest. Gujarat Gas made a statement after market hours yesterday. The company is saying that the availability of our LNG is severely constrained at this juncture. So it has to look at its volumes accordingly. And it has issued a force majeure notice restricting the daily contracted quantity from the 6th of March, which is tomorrow. So these are the concerns, that there is no feedstock. So what do you do? How do you keep your volumes up? I mean, these are just situations perhaps beyond some of these companies' control. So watch for the entire gas space. Ramki Infrastructure is another one. It's received a large order. 1,400 crores is the value of this order. And this order is coming from the Maharashtra Industrial Township for the Digi Port Industrial Area project. So we'll keep this on our radar as well. So a couple of these stocks in focus. Before I take a quick break, BSC, Pankaj, let me quickly get your thoughts in. The development seems very positive. All the exchanges are trying to offer more and more products to shore up volumes. What did you make of this announcement? Having the Sensex Next 30 as a weekly product now.
So, Surabhi, don't have a view on BSE, but what we like in the capital market space is clearly AMCs. So, the investing part of it is clearly the segment what we prefer. And we have seen decent amount of correction in some of these names, like say HDFC AMC or Nippon AMC. So I think These are the segments where you don't carry much of a risk from the balance sheet perspective, and whether a large cap does well, mid cap does well, which we believe that most of the segments will sort of do well. So AMCs are a good proxy for overall market recovery.
All right, got that. Gentlemen, stay on with us. What we'll do is we'll quickly check out some statements that came in from US Treasury Secretary Scott Bessent. He was speaking to CNBC. And he was speaking about a whole range of issues, including how the US really plans to make the Strait of Hormuz operational again. He also spoke about tariffs. The US is levying that 15% tariff rate for all countries around the world. Check out some of those very important statements. Check out how some of the global rates are shaping up at this point in time. We'll be back, and then we'll have our own pre-open rates. Remember, the GIFT Nifty is indicating a positive start. Let's see if the bulls manage to prevail this Thursday morning. Back in a bit. Okay, good to have you back. So we're about 2 minutes away from our pre-open rates coming through, and hopefully the bulls will finally see some sign of green today, because that's the way global markets have shaped up. There's a relief rally across the board. Wall Street, Asia, a lot of Asian markets are up between 2% to as much as 11% on the Kospi. So we're gearing up for that. Hopefully the rupee will also see some relief. And the next couple of minutes, we'll have a rupee guest joining in to talk about some of the push and pull factors in the market. But gentlemen, I want to keep talking about stocks that are getting impacted because of this war. And L&T has been such a huge casualty. So first and foremost, Pankaj, let me get your thoughts on L&T. Down 10-11% in just 4-5 trading sessions. Is it a buy for medium to long-term investors, or do you still think there's uncertainty, so best to wait?
So Surabhi, like you highlighted, yes, it's down about 10-odd%, and our sense is that about 35% of their order book is coming from the Gulf region. And possibly it is, we could have, say, a second order kind of impact in terms of logistic costs also sort of going up. But our sense is that the kind of correction what we have seen is an opportunity to buy in stocks like, say, L&T or KEC International, or which has about 45% exposure. Similarly, Kalpataru about 37%. In fact, we are also liking some of the product companies. So capital goods as a space looks attractive to us, largely because not only from the overseas opportunity, I think the domestic capex cycle is looking a lot more better. We have seen that, say, for example, most of the auto companies and even ancillaries have announced capex post GST cut. And in general, power as a space is also sort of witnessing a good amount of announcements. So I think any kind of a significant correction in some of these counters, especially like L&T, is an opportunity to buy.
Okay, so that's a thumbs up on L&T. The pre-open session has begun, by the way, and as we're waiting for those rates to settle in, look at that, you're getting a 300-point pop. But let's just give it a couple of minutes to see what the final rates are like. In the meantime, L&T levels, Chandan, if you could help us out over here, and whether you think there is, it's time for a long trade in Larsen & Toubro.
So like L&T witnessed a corrective move on the last trading session, but the good part is it formed a long shadows as well, long lower shadow on the lower side. Earlier it took support near 37.20 and recovered till 44.40 marks. I believe the same support could act as a key level. In fact, on the weekly chart, it formed a bearish candle, but supports are intact. So my suggestion is buy on any decline or on recovery. Keep the major support near 37.20 and look for some recovery trade towards 4,000 to 4,050 levels.
Okay. All right. That's Larsen and Toubro. The Nifty is now settling down to a slightly more quiet 160 point sort of a pop. So let's quickly run through the pre-open session. What do we have? What are the gainers in the Nifty? Bajaj Finance, Titan, Shriram Finance, Power Grid, Mahindra and Mahindra. So it's pretty much across the board, as you can see. Yeah, let's just fire up the Nifty rates again. Those are the gainers. And it's stocks cutting across sectoral lines. Reliance, for instance, is up almost 2%. L&T, the one that we were just discussing, up about 2% as well. And we have a lot of other gainers as well. Hindalco, a lot of metal stocks were beaten down quite badly yesterday. This morning, it looks like that relief rally will help the metals part of the market as well. Then what else is there? HCL Tech, you've got some names like Infosys, small uptick on some of these counters, at least as the day begins. Axis Bank, ICICI Bank from the financial space also are higher by about 0.25%, at least at this point in time. So not much to worry about. Nifty seems to be now settling the pre-open session with about a 150 to 160 point up move, and the gainers are on your screens. On the flip side, you have Tata Consumer, Max Healthcare and Interglobe Aviation. These are some of the stocks that are still down. So FMCG actually is a little weak this Thursday morning, at least going by this session right now. And then on Interglobe, the concerns are still very much on because the crude oil prices are still very, very elevated at $83 to the barrel. One more stock that I want to put on our viewers' radar would be BSE, the one that we were just discussing, considering SEBI is allowing it to now offer more products in the derivative space. They'll be coming out with weekly derivative products on a new index, the Sensex Next 30. That's working very well for BSE. Stock last I checked was up almost 4-5%. Not BSEL, let's fire up the Bombay Stock Exchange. Stock's up about 4% in the pre-open session, at least at this point in time. So that's how things are Thursday morning. At least the start of it is looking pretty decent. Pankaj, very quickly, before we let you go for the rest of the day, you've given us some clues, for instance, L&T. What else? Leave us with some compounding ideas. And this is for a portfolio investor who's willing to hold at least for the next couple of months, if not years.
So, Surabhi, if I have to sort of look beyond this thing, then I think something like, say, for example, Star Health, Star Cement looks attractive to us. I think cement stocks have also taken somewhat of a beating because of the pet coke issues. So that is one company which is liking, which we are liking. We initiated coverage on Sakar Health. So that looks very opportunity, especially on the oncology side. So besides that, I think some of the product company equipment look attractive to us.
Okay. All right. Got it. Thank you so much for joining in, Pankaj. You have a great trading session. Good to have you on the show today. Thanks for being with us. Okay. Thank you. Well, for Chandan, we've got some questions coming in from our viewers. By the way, hi to everybody who's watching us on YouTube. And Chandan, specific questions coming your way. Okay. There's someone asking that can Chandan sir tell us about Hindustan Copper and maybe even gold ETFs? Gold ETFs have been so volatile of late because the commodity itself is so volatile. But I don't know. I mean, maybe not ETFs, but Chandan, if you've just seen the gold charts, international prices, whether you think higher levels are still possible. And the other question is on Hindustan Copper, but I think an overall view on metal stocks will help because again, they're getting very, very volatile.
Yeah, so yes, obviously when we are worried from the geopolitical concern, most of the assets class are likely to be volatile. So viewers need to keep that in mind. The risk of taking trade in any asset class will be comparatively higher. But yes, gold usually act well as a safe haven at the time of geopolitical concern, and overall we have positive view on the gold. Just couple of days back, gold made low near 135. If I look at the MCX chart, and has been consolidating above 160,000. So till it holds above 152, I believe it can again head towards 1,70,000, 1,77,000. So positive view on gold as a whole. Now, a query was related in copper, but let me first reply on national aluminum. I have positive view on copper and aluminum rather than gold and silver. So Nalco looks good. It made the bottom near 335, forming the higher base. So with immediate support of 360, it can head towards 390, 400 kind of level. Even on positional basis, we are looking for 15 to 25% move from current level. Now, if I reply on the Hindustan copper, overall trend was positive, but it has seen a corrective move in last 5 to 6 weeks. It made the high near 760 and now hovering near 550 marks. I believe some decline could be there, but with support of 500, one can look for recovery to a 600 to 625.
Okay. Couple of people I think have joined in late. They're asking, Chandan sir, please give us the Nifty level. And there is Karan who's saying, "Aaj market kaisa rahega?" We discuss this at around 8:30, folks. But again, Chandan, for the benefit of the viewers who might be joining a little later, now that we've seen this pre-open, let's just go back. Would you look at a trade on the Nifty or the Bank Nifty at all? And my same question, if you're getting this 120, 30 point pop at the open, would you short it? Would you stay away? What is the approach to the indices today?
Yes, would be for the benefits of viewers. So, guys, we need to keep in mind that India VIX is now near 20 marks. So, when VIX is at 2021, 300 to 400 points movement cannot be rolled out. So, you need to be careful if you are trading, because in trading without stop loss, you can't trade. And in such kind of scenario, small stop loss might not work for you. Either it will immediately hit the target or may go wrong. And mitigating risk is very important when you're talking about trading. But yes, for level point of view, the broader range is 24,000 to 24,750. Immediate range is 24,200 to 24,650. So use these levels if you need to initiate some option strategy or if you need to place some swing in between.
Okay. Some questions coming in from our viewers on these platform company stocks, Swiggy and Zomato. I guess people are also looking for domestic facing themes, because that's what experts are saying. In times of crisis, just look at stocks which are not, hit by what's happening in international markets, whether it's trade or whether it's, real wars or trade wars. So we've got Sai Bharadwaj asking for a view on Eternal, and Satvika is saying, can I hold Swiggy for 2 years? Okay. She's looking at an investment. How do you find these two names, Eternal and Swiggy, Chandan?
So on immediate point of view, the trend is negative because both the counter are making lower top, lower bottom on monthly chart from last couple of months. But if someone is looking for slightly bigger point of view, I'll give more positive comment on Eternal. If I look at the price behavior in last 6 months, the counter witnessed a corrective move from 368 to 240 marks. I believe somehow near 220, 230, it may bottom out to again witness a recovery towards 300, 320. So on trading point of view, better to wait and watch. But yes, if you are interested to go for investment and positional point of view, you can accumulate for target of 300 plus. To reply on Swiggy, here it would be tough to trade because major trend is negative. Stock is hovering near its all-time high of 280, but it witnessed recovery on the last trading session. My suggestion is try to exit on bounce and move to Eternal if you are looking to generate the alpha in comparative analysis. For level point of view, 280, 285 is major support for 320 kind of level in recovery mode.
Okay, all right, got it. I'm just going back to the screen to see what's happening also with the currency. And with the currency, there is a big relief up move that we are seeing. Yesterday, the big headline was the rupee hitting an all-time low. 92.15 was the level that the Indian currency had hit yesterday towards the close. This morning, it's pulled back very smartly. And we've got a rate of about 91.61 at this juncture on the dollar rupee, as you can see. Though the dollar index internationally is still not gone too far away from 99. It's not like the dollar is collapsing or anything. But generally, there's a relief in markets. Markets want to believe that there could be de-escalation. That New York Times report that we spoke about earlier, where New York Times reported that the Iranians have reached out to the CIA saying they want to kind of have some sort of a dialogue open. That is what has triggered this whole relief move across global markets. And that's the dollar index. Like I'm saying, it's not too far away from 99, but the rupee has really recovered quite nicely. At least for now, we've got a 0.5% recovery on the rupee. And it has once again dropped below 92. Let's pull up the rupee level once again. Yeah, there we go, 91.61. So that's a nice, more than 0.5% sort of relief move up right at the open itself. So that's the currency. Let's see if we can actually get Kunal Sodhani. We should be having Kunal join in. He is the currency expert and he looks at all the factors very, very carefully. Okay, I think we'll get to Kunal in the next couple of minutes. In the meantime, what else is moving on the green screen today? It is a green screen across markets. Ramki Infra is another stock that was in news. Remember, we told you about its order. It's won an order worth almost 1,400 crores in Maharashtra. So that stock is up about 5.5%. What else? In terms of the green side of the screen, you've got Motisan Jeweler. Some of the jewelry stocks are actually up and about, at least for the time being, for what it's worth. And some of the shipping names are also, shipping/port names, they're also on the upside of the screen. Watch for sugar. Yesterday, a lot of sugar stocks rallied because the fear is that a lot of now sugarcane is going to be diverted towards ethanol production because there'll be a shortage. I'm just simplifying this down because there'll be a shortage of crude oil in the market. And therefore, more sugar will be diverted towards creation of ethanol. So therefore, there could be a sugar shortage. Therefore, sugar prices can shoot higher. And that is why sugar stocks are up and about in yesterday's trading action. Some of that is still continuing. For instance, I can see Bajaj Hindustan still up 2.5% in the pre-open. Chandan, what did you make of the sugar move yesterday? It's all very sentiment driven. These things can change in a matter of hours. But that's sentiment right now कि sugar का दाम बढ़ने वाला है. So would you trade anything here in the sugar pack? Still positive trades on a lot of sugar stocks this morning in the pre-open.
Yeah, so we have seen recovery in sugar and we were looking whether it's war effect or whether it's the reason behind the Holi celebration. And finally, if I look at the comparative analysis, most of the counter witness buying interest, whether we talk about sugar or ethanol counter, whether Bajaj Hindustan or Renuka or Balrampur, or whether we talk about Praj Industry. But Triveni is one of the strongest counter. It has been making a high top, high bottom. If I look at the monthly or the weekly time frame, even on the daily chart, it has been finding sustained buying interest at 370. It has multiple barrier near 400. Yesterday, it moved towards 418 but closed below 400. So I believe hold above 400 could see the positive trigger. In fact, we have seen huge volume in terms of trading and delivery, which indicate that some accumulation is happening in the counter. So with support of 385, I believe Triveni can head towards 420, 435 levels.
Got it. All right, Chandan, thank you so much for being with us throughout the pre-open session. Very, very helpful context and cues and, of course, trades as well. Good to have you on the show today. You have a fantastic session and we look forward to connecting again. Thank you.
Thank you so much.
Okay, well, before we hit market opening, let's just address the currency. And as promised, we do have Kunal Sodhani, Head of Treasury, Global Trading, FX and Rates at Shinhan Bank now joining in. Kunal, great to have you with us on Moneycontrol. Thank you for taking out the time. So finally, we get that relief rally because we're seeing a relief move across global markets, right? So we've got about a 0.5% pullback on the currency. How durable do you think this can be?
So I think if we see the offshore, like before the market opened, RBI did intervene very aggressively. In fact, whatever the opening we are seeing on screen, which is around 91.57, 58, you'll be surprised to know that we did hit a low today itself of 91.08. So 91.08 also got traded today, which is obviously, indicating the strength of intervention which RBI wanted to have. All the bids were off. But sustainably, I believe still it remains buy on dips for dollar rupee pair. We believe that 90.80, 91 big figure levels act as a very important support zone because somewhere we have enough emanations in terms of FX reserves to the tune of $723 billion. And thus such kind of intervention and interim interventions may be expected. But geopolitical issues are still not off the table completely. So we need to be quite cautious. A couple of quick things, maybe in a minute, I'll just summarize. Because the crude oil prices, if you see, are still hovering around that 83, 84 dollars per barrel. So it has not eased anything, though obviously global equity markets have rallied overnight. But if we talk about crude specifically and some statistics, it's clearly indicating that in India is almost
Kunal,
50%. Yes.
Yeah. Kunal, I'm so sorry. I'm so sorry I'm interrupting. The equity market is just opened. So just allow me 2-3 minutes to go through the initial rates.
Sure.
And then I want to come back to some of the key points that you're making that yes, crude hasn't really, cooled off. So what should we expect ahead on the currency? Just give me 2-3 minutes. Okay, so we've got a 100
Sure.
point upswing right at the start, as was expected. That's what the GIFT Nifty was indicating. That's what global markets were indicating. Now, the question is, how durable is this bounce going to be? The bounce was coming anyway. The market was oversold. But let's see what happens from here on. So, what are the constituents of this bounce? By the way, the mid-cap index is doing so well. It's double the gains compared to the Nifty. Look at the mid-cap index, up 1% at this point in time. Bank Nifty is up about 0.75% as well, and the advance decline ratio is looking really healthy after a long time, one would have to say. Okay, on the large cap screen, let's look at the Nifty gainers. And what do we have here? Bajaj Finance, Adani Ports, L&T. It's a relief rally that's cutting across sectors, really. Almost everything on the index is up and about. Reliance is taking things higher this morning, 1.5% up. There's Shriram Finance, there's Tata Steel. So metal stocks, energy stocks, financials, everything is up and about. You've got M&M about 0.5% higher. Tata Motors is up. Cipla and Dr. Reddy's from the pharma pack looking not bad at all. Some of the tech stocks are also seeing some buying. Yesterday, technology was becoming a bit of a safe haven in times of such heightened uncertainty. And even this morning, there are some positive bids on both HCL Tech and a bunch of other tech names as well. Let me see what else is rising in the market. So Wipro, Jio Financials, Bajaj Auto, everything really, pretty much everything. There is no stock on the Nifty right now which is down more than 1%. It's that kind of a sweeping move that we've got on expected lines. The stocks on the downside would include a Max Healthcare, which is now close to about a % loss. There's Interglobe Aviation, which obviously is going to be under pressure because crude oil prices, despite whoever is saying whatever, President Trump, the Treasury Secretary providing safe passage to ships across the Strait of Hormuz, none of that is helping the crude market. Crude oil is still at $83 a barrel. So that's still weighing on Interglobe Aviation. And ICICI Bank is having a bit of a quiet morning. It's down about 0.5%. So those are the pull down stocks. But otherwise, the whole market is up and about. And you can see that on your screens as well. Very, very decent gains coming in on Reliance, on Coal India. Reliance is, what a move. 2% on Reliance, really helping the bulls' cause this morning. L&T is seeing a bit of a pullback as well. Still not back at 4,000 L&T, but trying to get there. 1.5% up on Larsen & Toubro as well. So those are some of the big gainers on the Nifty. Now I want to talk about what's happening in the mid-cap market. By the way, let's start with BSE because that was the one stock that was in focus because they're getting that SEBI approval to launch more index-level products. So the Sensex Next 30, the derivative product on that will start trading very, very soon. And that's working well for Bombay Stock Exchange, up about 2.5%. Let me talk about some of the other interesting gainers. GE Vernova T&D, 5% on this stock. LT Foods, the basmati rice stocks, because they have big exposure to the Middle East, and now the worry is that whether basmati rice prices will start going up as well. LT Foods is up about 5% at this juncture. Ramkey Infra we discussed because of that big order win. Ramkey is up about 5% as well. Some of the other stocks on your screen, Bharat Forge, SJV, and Bharat Forge will be reacting because the Class 8 truck order data from the US is a little positive. So that stock's up about 3.5%. Solar Industries continues its good run. It's had a good week actually. Some of these defense names, specifically solar, benefiting from all the geopolitical tension which is out there. MRPL having a bit of a relief rally as well. Actually, speaking of relief, let me see what's happening with the oil and gas pack. Gujarat Gas, which has declared a force majeure, there was also a stock on our stock list this morning because they simply don't have enough gas availability. That stock's down 5.5%. Should look at Gujarat Gas. IGL is having a bit of a relief up move. IGL was down very sharply yesterday. And let me see what Mahanagar Gas and Petronet are doing. We'll just get them on the screen as well. Should put up Mahanagar Gas, which is up 1.3%. And let me quickly pull up Petronet LNG. Petronet was down 9% yesterday. Mahanagar is seeing a relief. HPCL is seeing a relief. Chennai Petro is up and about as well. Petronet is up about 0.5%. So it's not really like pulling away in a big fashion because there's still very much a lot of uncertainty on what happens to gas availability. Qatar has still not restarted its production. But for the time being, at least there's some little green on some of these oil and gas names. We'll keep flashing more rates. The mid-cap market is having a very good session. 1% up on the mid-cap index. Really, that's where the gains are concentrated, at least for the time being. So more stocks on your screen, but getting back to that currency conversation with Kunal. Kunal, I completely agree with you, and that's the point you were making, that while I think RBI intervention helped the rupee today, and we have this big 0.5% gap up, would you expect more RBI intervention? Actually, some would argue that it was a little surprising. The RBI typically steps back when there is, this event-driven volatility in the market. It allows the market to settle. But what did you think about the strong manner in which it came to defend this 92 level? And would you expect more of it in the coming days, given that oil is still elevated, given that uncertainty is still happening, the war is still on?
So first of all, I mean, such kind of interventions obviously can never be predicted, because ultimately, if something which is predicted as an intervention, then obviously it loses the purpose. So I think it was some very unexpected lines, but obviously the timing of the intervention cannot be known. And the last lows for rupee was 91.99, as compared to, not taking the cues from yesterday. So I think the psychological 92 barrier was taken off. So somewhere one anticipation was there that there will be some intervention seen. But yes, going ahead, I don't think there will be sharp intervention. So if you talk about 2025, there have been similar interventions 4 times in the entire year, with such intensity where more than a rupee move were also seen in a day. So this was one of the similar kind of interventions which I see. And then they take and markets determine the equilibrium based on the demand and supply once again. So I believe this intervention may be done for the day, I mean, and then let the equilibrium be decided by the market participants. Coming back to the crude price, where again we are on the same page, where the crude prices have not cooled off. An amazing snapshot which you gave right now on the equities. I believe the India VIX, first of all, was trading around 20 to 23. And whenever historically India VIX have been to those levels, markets are seen in green the next day. And I think that is one of the reasons we have seen the markets, I mean, opening up green. Technically, historically, this has been the case. Sustainable, non-sustainable, time will tell. But with respect to rupee and the crude, some important stats which we were discussing was obviously 80% of our imports are oil, and out of 80%, 50% we are, which is through the pass-through of Strait of Hormuz. Now, considering the oil price is moving 25% higher, which already has been the case from $70 to $85 now, $15 billion of import bill rises straight away, which is an important factor to note because it will further widen
Yeah.
the current account deficit and fiscal numbers for us. So fiscal maths will be taken off. Even if I point out the GDP numbers, 0.2% of real GDP will be lower and inflation will be higher by 0.7% if there is an increase of 25% in crude oil, which has happened. So macro pictures and the macro numbers may not turn
Yeah.
positive, at least in the near month to come in, which will definitely have some impact on rupee. Yes, interventions could be seen, but I still feel lack of clarity, and any dip like this gives traders some opportunity to cash in and come at lower levels. But positive side of this intervention should be taken by importers, because the kind of uncertainty it has in the intervention we have seen, importers should make best use of such case and try to hedge themselves at least partially at these levels, because completely staying unhedged and then being undecisive above 92 levels creates a lot of mayhem in the system further for rupee depreciation. So anyone who has ECBs or maybe,
Sure, sure,
the
sure.
import side, they should hedge. Yeah.
Yeah, yeah, yeah. No, absolutely. By the way, I just want to point out that far from easing off, Brent oil prices right now touching almost 84. I mean, they're closer to 84.
Correct.
Like yesterday, when we ended our trade, we were talking 81, 82. This morning, we're talking 84. So, despite whatever is being spoken about the Strait of Hormuz opening and safe passage and the talks of de-escalation or the Iranians reaching out to the CIA, the crude market is not buying it. That's the short point. And that's
Correct.
something that we have to be very, very cognizant of. I think we've got Harendra Kumar also joining us in the conversation now. He's Managing Director, Institutional Equities at Elara Capital. Let's see if we have him. Yes, we do. Harendra, good morning. Great to be connecting with you. It's been a while. And I mean, I'm glad we're connecting on Moneycontrol this morning. So welcome to the show, first of all.
Good morning, Surabhi. Nice to chat again.
Yes, absolutely. So Harendra, when I decided that we want to do this conversation with you, it was about Q3 earnings. We've been planning this for the last couple of days, but now the agenda has shifted. And now we're talking geopolitics on a lighter note. Obviously, we'll talk earnings as well. But Harendra, we have Kunal from Shinhan Bank, and he's the currency expert. And we were just discussing this. How much of this relief rally will last? Is it durable? Are we past the worst or not? Let me take your opening thoughts there. And then we'll get down to a more focused equity conversation. But what have you made of everything that we've seen since Saturday?
Yeah, so see, first and foremost, this is of course an energy shock that we are trying to anticipate and trying to measure up on how it is going to play up on the earnings. But I think beyond all this, we have to realize that India has seen $140 during the Ukraine crisis as well, but the pump prices did not change. So the equation is whether the government will go out and change the pump prices. So if at all, the negative impact is for the oil marketing companies. That of course the fiscal math changes a little bit, but this is only if the problem in Iran prolongs to probably beyond 3-4 months. So that's a wait and watch at the moment. But as of now, at the pump prices level, flow through to inflation is not so much as a concern. Yeah, with respect to direct impact on companies like Petronet, LNG, or Gujarat Gas, this the market is pricing on a live basis. But overall, it's a wait and watch. Some sectors like autos have overreacted. Our experience shows that after the Ukraine crisis, the stocks did a fantastic rebound. So yes, this current volatility is giving you an opportunity if the problem is contained in the next 30 to 60 days. So that is how we are viewing the current state of affairs in the market.
Got it. That's a pretty long window, 30 to 60 days. That's interesting that you're saying that investors should be able to ride this out for, say, another 2 months. That's a pretty long cushion, I think, that you're working with. So let me take a final question on the currency and then we'll turn full throttle to equities. Coming back to you, Kunal. Now, it's anyone's guess what happens, but if we work with the assumption that crude doesn't cross 85, you leave us with two scenarios. One is that we remain in this range of 82 to 85 and there's this back and forth of when is the crisis ending and are those missiles flying or not. But crude remains limited in that range. What are the implications for the rupee, the macros in that case? And then leave us with an outlook for the other scenario as well. If there is a spike taking prices above 85, if we start talking 90, etc., that worst case situation, then what could be the potential implication for the currency?
So first of all, if it stays around these levels, 83 to $85, consistently around these levels for a couple of days, I think market has already discounted that in price and across the asset classes also.
Yeah.
The surprising part is irrespective of that, obviously we did not see a rally in gold, silver or in any base metals, which is a last leg to be left. But for rupee, I think then in this case, the worst was already done at around 92, 30, 35 levels in case the sustenance is around these levels. But if the crude oil prices moves towards $90 or higher, then I think we may test new lows for rupee once again. Because I think the current account deficit numbers will again widen sharply, so which will have a definite impact that more dollars will be required to service those. So then I think 92.5, 93 levels may be tested if it is above or around $90 per barrel.
Okay. All right. Thanks very much, Kunal, for joining in. Helpful perspective. We're living in very uncertain times and we hope to see you more often. And we'll keep connecting.
My pleasure.
Depending on how the situation plays out. Have a great day. Thanks very much for taking out the time this morning. Thank you.
Yeah, take care. Bye.
Okay. Thanks. Well, I must report as we get back to our conversation with Harendra that the market is kind of cooling off a little bit. The Nifty started with this 130, 140 point kind of a gap up and now it's about 80 points. So still retaining the gain, but we need to see. It's a long day ahead right now. Harendra, that's the issue really. You're saying that as long as this doesn't spiral out and it settles in a month or two, this is a great buying opportunity. But in the interim, in the near term, I mean, there are question marks being raised on fiscal and what happens and oil availability, so on and so forth. You think those concerns will remain limited to, say, the oil and gas space? We saw the reaction yesterday on a Petronet, on an IGL, etc. So will the implications of this war remain limited to a few, stocks? Or could it start having a market-wide implication?
Yes, if it stays longer, clearly it will have a market-wide implication. But, you have to see that the countries that are impacted are mostly the developed world. So if you see the way South Korea is reacting or the European economies are reacting who are dependent on gas and energy more than India, I'm sure the world opinion will shift towards trying to contain this war. So when we started off, that's why we said is probably 30 to 60 days is the window, probably outside window that we should take the pain, and before which, of course, things would start to resolve. President Trump has himself said it's 2 to 4 weeks, right? So we are tracking an outside limit to, the best case assumption that the people who are involved in the war are saying. So in that interim, it is obviously the market prices in earnings risk for some of these companies very directly. But in my view, like I said, the pump prices did not change. I don't think the government is going to change the pump prices now. Other than the impacted parties, I think the larger problem will get contained. So at the intermediate, it's the oil companies that will face the issue. But beyond that, of course, it could create problems. But our best guess is it will not. So any other sector that's reacted on the basis of this war, even for that matter, Larsen and Toubro or like autos that we've discussed or some other names, I think they are providing great opportunities. Even Asian Paints for that matter, people who have implied higher crude on the longer term, and the stock prices have corrected. So we are evaluating these opportunities probably to recommend to invest.
Okay, got that. Harindra, let's take a couple of steps back. Before this Saturday, I mean, all up throughout February, the concern for the market really was IT and this IT disruption. And despite all the fall in these large cap IT names or mid cap IT names, at a net level, FPIs were still buyers. I mean, we were net positive in terms of FPI flows in February, which was fairly heartening. Where are we from that standpoint in terms of just the FPI selling ending? Do you think it was ending as we entered February post-budget? And what do you see foreign institutional investors doing now?
Yeah, so first and foremost, yes, we put out two viewpoints. One is around early December and in our strategy note as well, that FPIs will return in this calendar and fiscal year. I think the call out was very, very emphatic. One, primarily because we had presaged a big earnings recovery in the current financial year and going ahead into the next financial year as well. And this was primarily driven by the increase in nominal GDP growth, which is basically inflation returning into the economy. Sometimes luck, of course, works in your favor, and the numbers actually have demonstrated a strong rebound. I think that is the first testimony that the markets were looking for. So the Q3 earnings were slightly more optimistic than what we estimated, and the FIs seem to have taken cognizance of that. Clearly, we were oversold as well. So what we saw with the return of the FIs is the early uptick, into early buyers of our earnings cycle. So beyond the crisis, I think FIs will be serious during the current financial year. And that's the call that we had put out in January. So I think this trend will continue beyond this current volatility.
Okay. So let's now talk about earnings, because that was a silver lining, and I was going through your earnings note at the end of the third quarter, and it seems that at least in your coverage, you've seen a fair amount of green shoots, particularly in mid-cap and small-cap stocks. So run us through where the expectations stand now, Harindra. Will we really see this durable double-digit market-wide earnings growth come back in FY27?
Yes, absolutely. I think there are two, three things. One is at the headline level. I think what the market is mispricing is that the potential GDP growth of the country has gone up. Which was earlier pegged at 6.5, now it's 7.5. I think with all the trade deals and the reform process, we should nudge upwards in the next 24 months to around 8% plus. I think that will have a huge flow through into the earnings cycle. Second, we've discussed is the inflation. And already you're seeing this playing up in credit growth, I think, and capex announcements and people trying to put up additional capacities. So I think the wheel has started to turn. And to top of it, you will have the pay commission this year, which is much, much beyond the GST cuts or the incentives given in the last budget. So the government is working all the levers, and that should play up in the overall GDP and inflow through the earnings. Now, beyond this, I think I want to point out one on the rupee. The rupee is at its lowest on the rear. So I think to expect serious corrections in the rupees will be an overkill. So I think at some level, the rupee should bottom out, and also the FIs are taking cognizance of that. Very importantly, China came out with its GDP expectations. I think it's quite tepid. On the emerging market basket, India is actually quite underperforming compared to other resource-rich nations. But I think that turn will take a turn as well. So all in all, it's kind of a Goldilocks for the year beyond this current volatility that you see in the markets.
Goldilocks for the year. Wow. What could that mean for the index, Harendra? I mean, some idea of maybe some rough ranges that you're working with, Nifty?
I think of a 15% on the headline index from this year is a reasonable expectation. I think more importantly, it's not about the absolute number, it's about the trend that will take, continuing into the next fiscal as well. So I think the Nifty PE at around 19 times forward looks to be slightly on the higher side, but I think it will hold given that the earnings tailwinds are with us at the given moment.
That's a fantastic headline. Wow. I mean, 15% growth at an index level. We haven't seen that in now, 15, 16 months, almost 2 years, right? So investors are going to love it. But you're talking about this kind of a move in calendar year 26, or are you saying largely in FY 27?
We keep a fiscal number, earnings to earnings, right? But it doesn't matter. It's 3 months here and there. But more importantly, is the trend direction. So what we're seeing is what kept the markets down for the last 15 or 18 months, right? They are reversing. One is valuation, second is earnings, and third, of course, the overcorrection, the rupee, and the FI is going out. All have turned. So our best guess is, that all this turning, you should, climb back to what the nominal earnings should be discounted at. So that gives us a 15% return for the fiscal.
And what would your recommendation be if the market is finally turning a corner and we're finally getting out of the woods at some point this year? Then which are the sectors to back?
Yeah, I think, of course, the NBFCs at this given point of time, will start to do really well. I think private banks will perform, but it will be NBFCs and PSUs who will continue to lead because there is still headroom for PSUs with respect to the valuation, credit growth, the large corporate lenders where you're seeing the traction. And I think the NPAs are performing much better than private banks. So I think starting off, I think that should do well. And then, of course, you will have the return of some of the capital goods play, given that the government is doing the heavy lifting with respect to rejuvenating the power sector. So you will have NTPCs and some of the other power value chains start to do better as well from there on. And I think consumption discretionary will hold and continue to deliver. So I think these three areas is where you can be overweight.
Final question, Harendra. I did notice, and let's actually put up those graphics on some of the stocks that Elara likes at this point in time. So I'm just going to end with this. The large cap picks include names like Eicher Motors, TVS Motors, Titan, Kotak Mahindra Bank, a bunch of financials out there as well. There is SBI, Bank of Baroda, Bajaj Finance. There are a lot of mid caps there. GMR Airports is Nykaa. Small caps include something like a Delivery, K-Fintech. So it's very diverse across various sectors. You do have a favorable view on a couple of oil and gas names, Harendra. I noticed those names include an IOCL, an HPCL. So any reason to revisit that positive view right now, or do you think you'll hold and you'll let the next 2-3 months go by before taking a fresh guard? Right now, you're retaining that positive view on even oil marketing companies?
So oil marketing companies were in a big capex cycle. The government was allowing them to retain the profits so that they could go out and spend and increase their book value. That was the view before the war started. But we also had another company, which is Oil India, which is a big beneficiary of the oil price jump and the connectivity of the gas grid. And the stock was underperforming because primarily the oil prices were not moving up. So I think Oil India comes into play in the interim, even before the OMC start. So OMC's long term, if of course the prices correct back, the OMC's become a great trade. But if the crude scenario stays elevated, you have underpriced assets in Oil India.
Okay, all right, got that. Very, very interesting conversation and lots of positivity and sentiment boost for sure, Harendra, because you're seeing clear visibility that it gets better from here on. And investors have been investing, especially mutual fund investors have been investing, keeping that faith and that hope alive. So good to hear. Thank you so much. Looking forward to more of these conversations. You have a splendid day, and we look forward to connecting again on Money Control soon. Thank you. Thanks. Okay, by the way, look at the market before we introduce our next guest. And our next guest is actually from a fund house, and he manages plenty of money at Edelweiss Mutual Fund. But before we introduce Rebound Bhattacharya, just look at the market and see what's going on. It's fizzling out. This pop that we had, it might be lasting in global markets, but it's not lasting here in India. Because for India, the worry on crude oil is very real. And crude oil is still around the $83 to $84 a barrel. For India, the worry on gas supplies is very real. And gas supplies are still shut in the Middle East. So therefore, the bulls are not getting carried away, and the bears still have a bit of a hold on the street, you'd have to say. Let's just keep flashing some stocks. On the downside now, you have HCL Tech, Asian Paints, TCS, HUL, Tech Mahindra. Flash the Nifty losers, please. And we'll see what's going on over here. Just broad-based sell-off, once again, across the board, across stocks, across sectors. IT's turned weak again, for sure. That's a very, very clear trend. And a bunch of consumer stocks also on the weak side. And some of the stocks that get hit with higher oil prices, like Asian Paints, like Interglobe Aviation. Those are stocks that are very, very cautious at this juncture. So we have an eye on the screen, but looking out for the losers as well. Okay, as those stock prices keep flashing, let's bring in our next guest on the show. As promised, we have Rebound Bhattacharya, Chief Investment Officer, Equities at Edelweiss AMC, joining in. Rebound, thank you so much for being with us. Good morning and great connecting with you on Money Control. Apologies, small delay. We were just looking at the stock market as well, which is volatile. I don't know if you could hear the conversation with the last guest, Rebound, but we had Harendra Kumar of Elara joining in, and he just told us that the market is going to rally 15% in the next 12 months. Are you as optimistic?
Well, I mean, if it does, it will be great for all of us, isn't it? But certainly, I think a couple of points which I would feel is that the bottom-up picture of India in the form of earnings has certainly improved. It'll probably get a little worse before it improves further, given where oil price is. And, we source about 50% of our crude. And 30% of LNG imports come from Hormuz, that channel which has been blocked as of now. So that will create a bit of a short-term headwind, and kind of, in the immediate quarter numbers, you could see some impact of that coming through. But that's a transient impact. Hopefully, kind of, the war situation normalizes over the next month or two, and we get up and running. As that happens, directionally speaking, a few other things are in India's favor as well. So I understand the optimism. I also understand why the market's giving away some of the gains. But it's what we deal with. It's a life situation in markets, isn't it?
That it is. But today, just when we think that we've seen the worst, we get more hits. So we thought trade deal is a headwind, then trade deal got resolved. Then AI disruption was the new headwind, and we were just wrapping our heads around that. Now we have a geopolitical conflict, and that's the latest headwind. So, I mean, the bears seem to be constantly having a lot of ammunition.
Yeah,
what have you made of some of these recent developments? And even on the trade front, we don't know, right? Whether that 18% deal with India, whether it's on, off. Now that new rate is 15%. So the uncertainty on trade hasn't gone. The uncertainty on AI continues. And plus you have geopolitics. So quite a troika.
Indeed. I think the other way I could flip it saying that what else could go wrong? So all the things that could potentially be against sort of particularly our sort of construct of the economy, which is we are an oil and gas importer. A deal from the United States, we were sort of kept out for a good year and a half. That got struck, and also given where currency was, that also was an impact. So a lot of negativity has got flushed out of the markets and is sitting in the current earnings base, is the way I would look at it. For long-term investors who are watching this, I think this is an important statement that I would like to make, that over the last 12 to 15 months, we have seen a good round of earnings downgrades to the tune of about 12 to 15% at Nifty level, and broader markets could have seen even more. That has already passed by. Last year was the time when we didn't have any sort of, global deal coming through. And hence from August onwards, we did see a business impact of that come through. We have finally come around that. Yes, there is uncertainty overall when the normalcy would return. But from a framework perspective, at least agreement is in place. So earnings are depressed. We have seen in the last couple of quarters a bit of earnings upgrades come through. Macro continues to be fairly challenging, and which is impacting our multiples and hence our relative performance versus global markets. But the precursor to all of that changing is basically, earnings. There, a bit of green shoots like we have seen over the last couple of quarters after having seen 15% cut makes me feel that it's not time to completely step away from markets, but given the near-term headwinds, maybe a little greater in terms of exposure to markets. So that's the way I would put it, Surabhi, as opposed to being outright bearish.
Okay. I guess when you're in the market, and everybody who's in the business of capital markets, we have to keep optimism as investors, as money managers. When you've got to keep that optimism alive, right? Okay, Trideep, let's talk about the real numbers, earnings, and our valuations, because everything else is beyond our control. After Q3, and given the universe of stocks that you own and your fund managers own, what do you think about the quality of earnings, the trajectory of earnings? And is there a risk to that, given some of these macro risks that we discussed?
Sure. So to put this in context in a time series, right? So, starting, let's say, middle of 2024, that's when the earnings downgrade cycle in India actually started. All the way till September 25, which is around about 6 months ago, we went through an earnings downgrade cycle of roughly about 12 to 14%. We cut our earnings estimate by that much. Indian markets underperformed, stocks didn't do well. Last two result seasons, the September quarter result season and the result season that went by, we have seen about 1 to 2% earnings upgrade for 2 consecutive quarters. And of course, crude will be a bit of headwind in the quarter, but we will net we'll probably still see 3 quarters of earnings upgrade come through. So the earnings kicker has started to bottom out overall, despite the near-term headwinds. What's not resolving ourselves is basically on the on the macro, which is impacting the valuations. So if you look at valuations today at Nifty 50 levels, we are slightly higher than 10-year average. Overall, and that is where kind of all of this negative macro headlines is kind of keeping us from going further. Hopefully in a bit of a correction that kind of realigns itself, and then the earnings growth story starts to kind of reflect itself. But we'll have to see some of these macro headwinds pass by, which I think given 1 or 2 quarters that might actually stand to come through. Fundamentally speaking, we also have to keep in mind that this year could be an El Nino year, which could impact some of the consumption kind of basket overall as we look through the next couple of quarters. So when I look through this, immediate quarter earnings probably looks okay. The war situation, it's an evolving situation. In the near term, given our exposure to crude oil, will probably be a headwind. And we'll probably resolve this by the time we get to in a few months' time. That's when we will start to see the turnaround. So earnings better, valuations mediocre, macro bad is my scorecard.
So if I connect everything and read between the lines, Trideep, this means range-bound markets continue?
Yeah, so that's why over the next 3 to 4 months, we would expect a bit of a range-bound markets, bottom line or bottom line earnings, trying to move up, but at the same time, macro headwinds keep us down, which is why I was talking about a staggered sort of an investment style rather than trying to kind of, get in a jiffy. But, compared to about 2 years ago, the fundamental on-the-ground situation in terms of earnings is certainly better. And I think investors should take note of that.
Trideep, finally, so let's come down to brass tacks in the advice to investors. Of course, investors have been largely, continuing with their SIPs and they're still investing. Equity funds are still getting in the money, but investors are also getting a little restless. And that's very evident in the way the gold ETFs pulled in 24,000 crores last month, right? I mean, they're trying to find alternatives. Multi-asset funds are getting more money. Gold, silver ETFs are getting a lot more money. So it also shows you that investors are becoming a bit impatient. They've been waiting for over a year and a half. So what would your advice be? Pure equity advice. Where to park the money? Where will this recovery be visible whenever it comes?
So I think a combination from an equity standpoint, I would say a combination of a flexi-cap fund and a mid-cap fund is a good way to approach the market at current levels. Flexi-cap fund, maybe a majority of it, but some part in the mid-cap category is the way we would slice and dice the market. Flexi-cap is a large-cap dominant portfolio, and that gives a bit of safety in terms of valuations. But as we go through the year, as we go to the second half of calendar year 26, and some of these geopolitical headlines recede and earnings upgrades start to be more visible, you would see the higher beta to earnings upgrades would be in the mid-cap category, and hence a combination of these two would be the two favorite categories that we would go for. But mind you, we would advise a staggered entry from here till the middle of the year. That's a good way to sort of capture maybe the conflicting or the negative macro headlines with a bit of positivity over the medium term.
And as far as your funds are concerned, FlexiCap and other funds across Edelweiss's bouquet, is there a bias towards large caps more than mid caps, small caps? I mean, just generally, what is the construct right now in terms of sectors and market capitalization? Where are the scales tilting for the set of funds that you and your team manage?
Sure. So at the moment, it is large cap. We in our flexi cap fund, close to about 65% of our portfolio is large caps, and that kind of sinks in well with regards to my balanced commentary, with regards to balanced optimism. That yes, the underlying tone is important and positive, but we do have to get through some of the headwinds in the near term, and hence that positioning. In terms of sectors, I think one of the things that we like is credit growth. On the improving trajectory. We think that credit growth, which was about 6 to 7% a couple of months back, will now get to about 12 to 14% over the next 6 to 9 months. And that, on a broad-based basis, will positively impact financial services as a sector. And hence, we are positive on lending financials, both banks, private sector banks, public sector banks, NBFCs put together. And along with that, we are positive on consumption and defense. These are the three areas that we are selective overweight. We are tactically overweight some of the rising oil price beneficiaries, but that's more tactical in nature, more than otherwise. Where we are a little kind of careful is where valuations have gone through on the higher side, which includes some of the maybe the quick commerce names where valuations went through quite significantly, where we have taken some profits out.
Okay, all right. That's helpful. Gives us some idea about how you're thinking about stocks and sectors, and this is the overall positioning right now. The great conversation as always. Thank you very much, and hopefully some of these macros also resolve themselves, and hopefully we come back to more bullish cues by the time the next couple of weeks are over. Thanks for joining in. Have a fantastic day, a great March, and we hope to see you again in a few weeks. Thank you.
Likewise. Thank you.
All right. Well, that's a view coming in from Edelweiss Mutual Fund on the market. So keeping a balanced view, that's what Pradeep is saying, expecting markets to be range bound. And therefore, they are a little more large cap oriented. And of course, he outlines some of the sectors that they like. Where is the market? The market is still retaining a good gain, 160, 170 points. The bulls are prevailing. So we've got about a 0.7% up move on the Nifty. The mid-cap index is doing really well, 1% up on the mid-cap index. The, of course, big question right now is where does this entire West Asia situation leave India and our macros, given our dependency on oil and gas that's coming in from the Middle East? We have with us now Dr. Manoranjan Sharma, Chief Economist at Infomic Valuations and Ratings. Dr. Sharma, thank you very much for being with us. So that question to you, sir, this whole situation, if oil remains at $83, $84 a barrel, and if the Strait of Hormuz doesn't open up quickly enough, then what are the implications for us, given our high import dependency?
Well, yes. Am I audible? Am I audible?
Yes, yes, you are.
Oh, okay, thank you. So I think
Yes.
even some of our calculations for the budget for current account deficit were predicted on the basis of oil being at something like 70 rupees per barrel. But now they're already, as you said, ruling at about 82, 83. But the future is very uncertain. Going forward, if, as you rightly highlighted, if the Strait of Hormuz is closed, 20% of global oil passes through the Strait of Hormuz, 70% odd of India's oil passing. So then all bets could be off. Things could quickly topple. Macros may not look all good because current account deficit will take a hit, trade deficit will take a hit, GDP growth could also be impacted, and there could be several other calculations. These are evolving situations. Yesterday, there was some kind of a reassuring message from President Donald Trump that he will go out to ensure two things: that the Strait of Hormuz is not closed, and secondly, for the ships passing, this risk premium, this was anticipated, this will go over the roof and throw all calculations out of the window. But he has also butted in to say that he will ensure that risk premiums are contained at a reasonably moderate level. So these are interesting situations. We'll wait and watch how things will unfold.
So, Dr. Sharma, what are the immediate implications for either current account deficit or even our fiscal deficit for that matter? Because like you said, the budget had forecast all its projections on $70 a barrel. We're already at $83 a barrel. So what could the implications be?
Well, current account deficit right now, if you look at the latest figures which have come in at 1.1% or 1.2% of GDP, so these are very moderate figures because we have done a lot of other individuals and institutions have done a large number of econometric, other elaborate exercises, and we have always found that CAD, current account deficit of over 2.5% of India to the GDP is quite manageable for a scale and size of India's economy. However, this will add about possibly about 40 basis points. We could end up with a CAD of something like 1.7, 1.8. This will also impact our growth. But then the most element to be watched out is what would be the duration? How long do these war last? Initially, we were expecting a quick resolution, say within 10 to 12 days. But now, as things are evolving, maybe we have to prepare for the long haul, and then things could rapidly worsen.
Okay, all right. On the rupee, of course, hit an all-time low yesterday. Today, there's some relief. It's recovered back to below 92. The currency at these levels of 92, how does that complicate our overall macro math?
Well, some good and bad points. So obviously, this would be good to our exporters. But then, since we have largely inelastic, inflexible imports, this is going to hit us hard. Also, some kind of an industries which are largely dependent on oil, such as aviation, logistics, paints, and chemicals. There has been some kind of a margin compression. So going forward, these industries could take a greater hit.
Okay. I mean, any particular sectors that you want to call out? I mean, there is already a worry for a lot of exporters because this was an important transit route and a fair amount of our exports also go to the Middle East, whether it's rice, so on and so forth. So, sectorally, what impact do you see if this doesn't resolve in the next 4 or 5 weeks?
Sectorally, I think apart from both our exports and imports will be hit. This is one of the most important. There have been several global choke points, but of those global choke points, is Strait of Hormuz is right there at the top. So a lot of things which go to, let's say, US, we have already facing, as you highlighted, the tariff issue, so many geopolitical uncertainty. So most of our commodity-based exposed, they could be hit sharply. Also, our imports, oil, and so many other things, these could be impacted.
Okay. All right, we will leave it there. Mr. Sharma, thank you very much for joining in and giving us some perspective on how the macros look like given the conflict in West Asia. Thank you. All right, with that, just checking what's happening with the market. The market's actually in cruise control mode. It's doing fairly okay. Mid-cap index up about 1% as well. A lot of metal stocks are recovering. Yesterday, they were slammed down big time. Look at Hindalco, 4.5%, Nalco, 6%, Mazgaon Dock, Shipyard, 5% higher. I'm just talking about some of the very active mid-cap stocks. There's Naveen Fluorine, GE Shipping is up. By the way, a lot of tanker rates have really shot up, given that all these ships are stranded across the strait. So these are some of the stocks in focus. LT Foods, 6% higher. This is what you're seeing, at least for the time being. Jindal Drilling, 5% up. Some of the stocks related to the oil and gas infrastructure space are also up and about. Data patterns from the defense space, 5.5% up. And the metal sector is having a really good run today, this morning as we speak. So looking good. ONGC, Coal India and Hindalco are the top three gainers. There's also Reliance. So it's entirely metal and overall commodity stocks which are leading the Nifty this morning. Hindalco, Coal India, ONGC, and then you'll see Reliance when we flip it over. Big gains on many of these counters. Let's do one thing. Let's also check out some of the stocks that are in news today, the news flow that's driving stock prices, and we'll be back with our final guest in just a bit. Okay, now as we get to the final leg of our show today, we have something really special for you, and this is something I'm sure all the viewers will really want to watch out for. We have Anubhav Sahu, my colleague from Moneycontrol Research, joining in. And Anubhav and the team, the Moneycontrol Research team, has been putting together something very, very interesting in these turbulent markets. They've been working on a list of beaten down stocks that have strong fundamentals around them. Now, these are not buy or sell calls at all, but just a set of stocks where the fundamentals at least seem very, very strong. Anubhav, first of all, thank you for joining in. Good morning. Welcome to the show.
Day, at least a positive moment in the screen.
Yeah, absolutely. We've come back with better cues. The bulls are back. And I think there are plenty of people who are out with their, bag of cash ready, because we know that these are good times to buy. These volatile times offer great opportunities. So Anubhav, first of all, what thoughts? I'm sure the team was looking at research, particularly on oil and gas as well, because a lot of these stocks got beaten down quite brutally in the rub-off. So what did you folks make of the market fall in the last 2-3 days? And then we'll talk about this very interesting stock list.
Yeah, of course. So, like broadly to set the context, in last couple of months, our team had been broadly constructive about Indian equities, and the reason being that some of the headwinds which led to Indian markets underperformance with respect to global benchmarks uh, seem to be getting rectified. Whether it is about urban consumption slowdown, corporate earnings slowdown, moderation, or the easing of relation with the US on the tariff front and all. And of course, the last but not the least, the most important factor actually being valuation getting sober in last 18 months of kind of underperformance. So we are getting constructive. At the same time, as far as the war, the current Iran conflict is concerned, I mean, we did a study on Middle East armed conflicts for last 6 decades, and found out that in a very short run, probably in a 1 to 3 month period, the war premium actually gets reduced significantly. And if you look at a time frame of 12 months, so some of the equity benchmarks like Sensex or S&P 500 do pretty decently. Of course, there is one exception: 1973 war, which led to oil embargo from the OPEC nations, and that was a very different outcome as for the risky asset classes reaction after a year or so. But we are relative to 1973. Of course, things are quite different. Dependence on Middle East on oil front probably has reduced. US, which was an importer, then is now a key exporter. And of course, the Middle East geopolitics has also significantly changed since then. So with that background, we thought current underperform actually brings in a good opportunity to look at stocks or look at falling angels, which one can consider in days to come. Of course, it need not to be done in a one go. It should be actually in a staggered way, because there are many unknowns as far as this war is concerned. We don't know the capabilities of Iran as far as the electronic warfare is concerned, and what role the China can actually play on that front.
Yeah, absolutely. Absolutely. I like the term that you've coined, fallen angels. So this is the fallen angels stock list. Now, I must tell our viewers that it's a list of 15 stocks which the Moneycontrol research team has put together, where fundamentals look strong, and that's why they're calling these stocks fallen angels. We can't tell you all the 15 stocks. For that, you have to be a Moneycontrol Pro subscriber. But I've convinced Anubhav to share at least 2 names with us to give us some idea, a little bit of a sneak peek into these companies. So Anubhav, take it away. And also, was there a common criteria? I mean, did you pick out companies which have a strong cash pile? Are these companies with a strong growth, projection going forward? Was there a common filter in terms of coming up with this list? And then, of course, tell us the 2 stocks at least.
Yeah, of course. I mean, the common filter was, it was more a bottom-up approach of looking at the business. Of course, some of the stocks, businesses are undergoing some of the headwinds, but the medium-term, fundamentals look intact. Balance sheet, which actually in the time of crisis is much important criteria to look at the cash flow situation as far as the cash flow yields are concerned. So those criteria we had a look at and came up with this list. So, of course, as far as the stocks are concerned,
some hints, some ideas.
Yeah, okay. I can probably talk about a couple of them. This one of my favorite is from the chemical space. Of course, I mean, we have picked these 15 stocks from varied sectors, ranging from hotels, CDMO, renewables, airlines, shipping, EMS, AMC, and so on. But this one is from chemical space. It's the leading rubber chemical play, Nozzle, which has significantly, corrected in last few quarters. So, I mean, to provide a context, it's down by 57% from its all-time high, 36% from 52-week high. And the reason being that there had been a heavy dumping on rubber chemical space from China and Korea for last many quarters. Now what we are seeing after GST2, that there is an uptick in domestic volume growth for Nozzle. There's also good commentary coming from some of the end clients of Nozzle, which are into tire industry space as well in the auto space, which brings in a reasonably positive outlook for the medium term as well the domestic industry is concerned. Other than that, company is also hopeful that the ongoing anti-dumping investigation, which are going on for a few of its products, probably would be favorable. But that's an optionality. On the export front, the kind of trade agreements India had with European Union, and that's quite a positive from the market access point of view. And also easing of trade relation with the US is another key relief for Nozzle, because they are claiming probably they can recoup 50% of volume as far as the US is concerned. And of course, last and the most important criteria in this case, in this list as well, is the valuation. So currently, Nozzle is trading very close to book value, so that provides a good entry, level to look at the stock is concerned. Yeah.
Okay. All right. So a turnaround in the business, attractive valuations, and good prospects ahead. That's why Nozzle makes it on the Moneycontrol Pro Fallen Angels list. Okay, one more name, Anubhav, before we let you go.
Right. So I have been quite positive about this. A few of the structural themes. I mean, our team actually, defense one of them. CRDMO is another, opportunity basket which we have been looking for on a very medium to long term kind of a thing. And this basket actually, in this phase, actually, we have seen that Syngene is one company to look at, which is a leading player. They have a high presence in the research side, and they have significantly corrected in last few months, and currently trading at deep discount compared to some of the peers like SciLife, Davies Lab, etc., and so on. And of course, it is not without a reason. They have been impacted by inventory adjustment by one of its key clients, Zoetis. But that being the case, company had been investing heavily on the capabilities and capacities for biologics. And for that, they acquired a unit from Sterlis Biopharma, which is now partially operational. They also acquired a unit in US, Bayview, which is also supposed to get commissioned this quarter itself. So they have a good spare capacity to look at to the structural, demand coming. One, because of the US Biosecure Act, which also kind of helps the global industry to decouple from China, and that's why the China plus theme should actually play out in India as far as the CRDMO space is concerned. And also in general, the funding environment for the biotech industry is also positive, so that helps Syngene. So from a medium-term perspective, it looks good. Actually, outside of Zoetis, the company is hopeful of having a high single-digit or low double-digit kind of a growth in time to come.
Okay. All right. Very interesting. 2 picks there. Anubhav, thank you for that. And viewers, remember, if you want to know the entire stock list, 15 stocks, we've only discussed 2. So there are 13 more. And if you want to know these other fallen angels, the beaten down stars, which potentially can rally from here on, given strong fundamentals, you need to become a Moneycontrol Pro subscriber, and you'll find such, very, very specific curated research out there. Anubhav, thank you very much for joining in. Have a good day. And we look forward to more snippets from MC Pro. Thank you.
Thanks a lot.
Okay. Well, as we are winding down on this edition of Closing Bell, the market is still holding on to gains 0.5% on the Nifty, about 1% on the mid-cap index. But we've spoken a lot about geopolitics, spoken a lot about the war. We're going to leave you now with something a little different, something which is related to America, but not exactly related to the war. US President Donald Trump met with leaders of major technology companies on the 4th of March to launch a ratepayer protection pledge. Now, what is this? This is aimed at preventing rising electricity costs linked to the rapid expansion of AI data centers. Companies including Google, Microsoft, Meta, Oracle, OpenAI, and Amazon have all agreed to secure or develop their own power supply so that growth of artificial intelligence infrastructure does not increase utility bills for households and small businesses. This initiative comes as voters raise concerns about energy costs and put more pressure on the US power grid ahead of the November midterm elections. Take a look at this news report, and thank you so much for watching us. And we'll be back with more news and updates on the markets in just a bit.
under this new agreement, big tech companies are committing to fully cover the cost of increased electricity production required for AI data centers, and that would be prices for American communities will not go up, but in many cases will actually come down and very substantially. Because, you know, the data centers, and you people are so big, you're the biggest in the world, but they've developed a little bit of a bad public. They need some PR help, because people think that if a data center goes in, their electricity prices are going to go up, and that's not happening. It's not going to happen. And for the areas where it did happen, it won't happen anymore. By 2035, energy demand is expected to more than triple. Under the ratepayer protection pledge we're signing today, the big tech companies are making 5 important commitments to keep utility prices down for American consumers. First, these companies are committing to provide or pay for all power generation and electricity needed for their AI projects, which is massive. And where possible, they'll add capacity to the grid by building new power stations. So they're going to be making their own electricity. They're not going to be taking from the grid, and they will actually, probably, based on what I'm seeing, they're building overcapacity, and they'll be able to sell that overcapacity at very low prices into the grid. In addition to that, we're fixing the grid.
It's been remarkable to watch this transformational moment and you positioning America to lead. Our country has had very big transformational movements before, whether it was coming together, World War II, or the Industrial Revolution. But this is different. The next 3 years, in many ways, sir, are the whole game. And those 3 years, while you are president, you have positioned us to win.
To protect American ratepayers, we're committed not only to pay for 100% of the energy we use, but very importantly, the infrastructure to support that growth, whether or not we end up using that energy. And I think one example that brings that to life, I recently had the privilege of being in Arkansas with Governor Sanders, and our energy partner there, Entergy, announced that Google's investment covers the full energy costs associated with powering our data center, which contributes more than $1 billion back to Arkansas customers to reduce their electricity costs.
Because of your work on this issue, I'm confident that we will win the race with in AI with China and succeed in delivering inexpensive, abundant electricity for the American people. As you know, XAI builds huge supercomputers and data centers, and we build them fast. Currently, we're building one on the Tennessee-Mississippi state line. As part of today's commitment, we will take extensive additional steps to continue to reduce costs of electricity for our neighbors. Mr. President, we want to be on your team to deliver a big win for the American people. XAI will therefore commit to develop 1.2 gigawatts of power as our supercomputer's primary power source, and that will be for every additional data center as well.